quick note before we start. Yesterday in our alpha report, I mentioned 7 days of positive momentum on GameStop. Volatility is low. $30 calls for January only cost you about 12%. Potentially desirable if you think momentum is just getting started. And take a look what happened yesterday. You started out at a low of about $24 and you ended the day up almost 10%, up 9.57%, which is pretty good. That option printed money yesterday. And if you want those totally for free, these sort of trade ideas, or I call it my alpha report, just things I'm seeing with volatility, momentum, or otherwise, just go to meetkevin.com/alpha and sign up. That's meetkevin.com/alpha. It's totally free. And we're going to extend this date as well for the free period, which frankly, I have no plans to monetize it at this point. Hey everyone, Meet Kevin here. Boy, oh boy, we've got a very bullish thing to talk about for Bitcoin and potentially the economy. And then we've also got something bearish to talk about. So we've got to balance both of these. Let's get into it. First, Bank of America just announced that exposure to stocks in the United States is at its highest level since 2013 after the presidential election of 2012, the end of 2012, on optimism for the economy. Now, keep in mind, in 2013, fears of a double dip recession, which were really rampant in 2010, 11, and 12, started fading and home prices were rising, which is the opposite of what you're seeing in a lot of markets today where home prices are declining. Job growth was present, and we didn't have an inverted yield curve, which right now we have no job growth, less job growth, and we are also in a place where we had a substantially inverted yield curve. So the reference to 2013 does have some bearish elements to it, but that's not the bear thing that we're going to talk about. It is worth noting, though, the market basically from 2013 on, after the second double dip recession was avoided in 2013, although it was never really realistic. I was in the business environment during this time. I remember it very clearly, especially in real estate. But anyway, the market was basically straight up until COVID. Really impressive and really bullish. Now, Bank of America this morning also put out a piece that now, when previously they had a shift, that is before the election, they had a shift of 10% more than the average of investors were projecting a weaker economy next year. That has now shifted to, rather than basically being negative 10%, to positive 23% of investors expecting stronger global growth next year. I don't know if that's because Jerome Powell, who's like, oh yeah, growth might actually surprise to the upside next year, which part of me is kind of like wondering, like, where are you getting that from? Like, are you just saying that to hopefully create the growth? I don't know. But it's worth noting that right now, 3 times the fund managers compared to before the election are now considered overweight stocks. So we're definitely at a level of high exposure to stocks. And so this has some folks wondering, okay, is there ever going to be a peak here? And what's the bearish thing that you're going to talk about? Well, the bearish thing I'm going to talk about is one of the most scary things that I've seen yet, but we'll get to that in just a moment. First, I want to take a look at Bitcoin. So this is bullish for Bitcoin in my opinion, but in my opinion, based on a few different economic or rather technical analyses that I've conducted, I think Bitcoin's next stop is either around the 102 to 103 range or potentially as high as 109, depending on where you place the floor for your Fibonacci extensions. Now, I think that's bullish in the longer term here, but that doesn't necessarily mean we're going to go straight to that position. And after we hit 90,000, we did start to see some profit taking until about 3 a.m. this morning, California time, more like 2:50. That was right when my alarm was going off. And we started rising again, but again, we're already starting to see some of that profit taking. So just a heads up, always expect some red days after some runs. But Kevin, what is this bearish thing that you keep talking about? Well, I was talking to my wife Lauren the other day, and she asked me, hey, is it like, what is the potential that the economy can grow faster than we expected next year, and that we could avoid a recession? And her question's very well pointed. It's a very direct question of, okay, well, hey, maybe if the stock market is rising and Bitcoin is rising as much as it has been, perhaps we'll be able to encourage companies and businesses to hire more people, which would then expand economic growth, and we could avoid a recession. Because right now we see job openings that are plummeting, or we see an unemployment rate that is trending up. Now, obviously, in the last few months, there have been some fluctuations. We had a really good September. We had a bad October. Average it together, things are slowing down substantially. Excuse me. From where we were at the beginning of the year. Beginning of the year, we were creating over 200,000 jobs per month for the first 6 months on average. Now, all of a sudden, we're creating less than 105,000, somewhere between 103 and 104,000 jobs on average for each of the past 3 months. That's a huge decline. On top of that, job openings are plummeting, which is usually what happens before a recession. Although job openings have been plummeting for a while, so there are some people who think that this is just a normalization. And none of this is mega bearish. We've all seen this before, including the level of 27 weeks or more unemployed workers rising, which really only happens in recessions or after recessions. Like, for example, the mid-70s here, you had sort of this post-recession recovery jump here, and a lot of people think this was really just part of that recession, whereas here, we had that post-recession jump, now down, now we're rising again, which should imply that we'll just cover that up a little bit, should imply that we're moving in towards a recession rather than out of one. Now, with that said, what, Kevin, is the most bearish thing that I saw? Well, what I saw was I wanted to go to history. I wanted to see, hey, Lauren, let's just look at the historical evidence for what happened when stocks ran and what kind of hiring we saw. So let's talk about that. We'll do that over here at the iPad. So here's what I found. When the stock market ran to all-time highs, such as when the NASDAQ 100 peaked in October of 2007, about 1 month after the first 50 basis point cut from the Fed, we ended up seeing the stock market, the NASDAQ 100, at 43.14. Okay, so keep that in mind. So now the question is, did we create jobs in that 2006 to 2007 period as the stock market was going to all-time highs, or potentially even right afterwards? And what I found, I just want to make sure that mic's working. What I found was no. In fact, job creation peaked out in 2006. So it's worth remembering that the stock market doesn't necessarily drive job growth. In fact, I would argue it has nothing to do with job growth, especially since money can simply evaporate in much the same way it was created when stocks go up. It doesn't necessarily transfer to somebody who could then spend it on jobs. So then I thought, okay, well, maybe that was just 2006 and 7. So then I looked at, well, what about the dot-com bubble? And I saw that we peaked in February of 2000 at 8,721. Optimism around technology, whatever. And so what did we end up finding in terms of jobs? Did we create more jobs when the stock market peaked at the beginning of 2000? Well, the answer was no. In fact, the job gains that we saw were really flat for about 3 years going into the dot-com bubble and during the dot-com bubble. During this entire surge right here, we didn't actually create more jobs. Job growth was flat. Instead, what happened was job growth peaked out in May of 2000 and plummeted into December of 2000 before we hit the recession. And that actually coincided with the fall in stocks, which the reason that's ridiculously bearish is, as written here, this is horrible. The stock market up did not lead to more hiring, which is the opposite of what seems logical. And as the stock market went down, you actually reduced hiring and we ended up driving into a recession. This isn't great. So then I wondered, okay, well, what actually creates jobs? And what I found is what actually creates jobs is not strong GDP, but accelerating GDP. So when the rate of acceleration, in other words, you're taking your big toe on the gas pedal and you're pushing it down more, or you're in a plane. I love the plane analogy. And the pilot is pushing the thruster forward more. You ever take off on a plane and then you kind of like level out right after takeoff and you're like, oh, whoa, that felt weird. Well, it's because you're not cleared out of the airspace yet often. And then once you're cleared out of the airspace, you feel them push the thruster forward again. Then you kind of take off again. Yeah, that's accelerating GDP as well. That feeling of, oh, wow, we're getting a real boost over here. We're getting some thrust. Who doesn't love some more thrust? Well, take a look at this. And that's why when you look at this chart, what you end up finding is almost a perfect correlation between GDP and jobs. Look at 2004 to 2006. The blue line is GDP. The red line is job creation, or both of these are the percent change year over year. And so the more jobs we created, you would see that reflected in a higher percentage of year-over-year job growth. And so you can see there's this correlation, GDP up, jobs up. Unless you were going into a recession, you could have GDP pop up into 2000, sort of bubble territory there, but jobs didn't react because people probably recognized, this is a little bubbly, we're not going to hire here. Now, surprisingly, people are actually pretty good at making these sort of business decisions at companies. Not necessarily the best in valuing stocks, but that's okay. That's different. Then what you have over here is GDP blue line and red line jobs again, except this time it's a snapshot of the 80s. Post-recession, the recession's over, GDP up, employees up. No recession in 1986, GDP up, employees up. Very simple. Okay, here's a zoom out of the past 70 years of this data. The correlation is pretty freaking clear. No recession over here in the mid-60s, GDP up, jobs up. Very simple. Well, what's happening right now? Well, there you go. GDP down, jobs down. So we're actually decelerating. We're actually taking thrust off the thruster. This is bad. In fact, I think this is horrible. So my initial response to Lauren was actually incorrect. I assumed that when the stock market goes up, businesses are going to feel more confident and they'll hire more. But that's not how it works. People only hire more when both sales are up, confidence that we're not going into a recession is up, and GDP is expanding. Well, we're not seeing expanding confidence of the levels that say we're not going to go in a recession, and usually confidence lags real data anyway. GDP is decelerating, jobs are decelerating, and stock market positioning is at all-time highs, pricing in perfection, frankly. Perfection in the Trump administration, and you haven't even really started seeing profit taking yet, with the exception of what you're starting to see a little bit in Bitcoin here. So anyway, thank you so much for watching this video. Good luck out here. Make sure to subscribe to the channel if you found this useful, and folks, we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.